29.49, 31.56. Well, what I'll do, and this is what I saw with Facebook, where I, I'll look at a 2-quarter average also. And this, again, this is if I'm doing analysis that I'm trying to hold for a bigger move and really trying to see sort of the bigger trend that's taken place. If you took a 2-quarter average of Facebook, you had a little bit of variance quarter to quarter, but they're very huge earnings: 58%, 108, 82. Yes, you had a little deceleration, but again, if you're having huge numbers and your 2-quarter average is accelerating, you're not worried about these small variances in between. So you look at the 2-quarter average: 6%, 29, 83, 95, 132, 152. It's no wonder that this stock underperformed here and then outperformed here. Just look at the drastic difference in earnings, and then you see the drastic difference in stock price. You're going to see all these big movers that I'm showing you. They're driven by earnings. Now, biotechs are driven by an expectation. So again, like I said before, you may not have the earnings on the table, but when we look back at the biggest winning stocks, upwards of 70% of them had earnings on the table. In the most recent quarter, you had earnings up 20% or greater. So you don't have to speculate. You don't have to like guess and know if the earnings are going to come out good. You want to look for them already on the table. Annual earnings it's going to translate into annual earnings, and you'll see an acceleration there too. And going back to Mark's point, where even in a bad market, you can have a stock that does really well. Here's a perfect example. We saw this before with Apollo Group. This big move took place during one of the worst bear markets in stock market history, the bear market that started in 2000. And look at this stock price. And you can see the annual 28, 30, 40, 55. You've got acceleration in earnings. This is what Mark talked about of a stock being in its own earnings cycle. All right, to drive this point home a little more, and then I'm going to show you a couple specific techniques or tactics to apply to earnings. I want to talk about Home Depot, and you just look at the contrast, okay, between, there's 3 things I want you to look at here. First, when the stock did really well. If you take these earnings, you had an average of 24% earnings growth per quarter leading up to this big move. When we got into this big move, which was, I'm sorry, per quarter, this is annual, we're on annual earnings. When you got into this big move, you had 37, 41% years, you averaged 39%. Big acceleration. Now, when you look at after the stock topped and it underperformed for 7 or 8 years, the average annual earnings are 15% versus 27, almost half. They're almost cut in half. And again, you can see how the bad news comes in way out here, years and years later, where you really slow down. There's an intelligence in the stock market. There's a real intelligence in the stock market, and this is something to fully understand. All right, so let me show you. We talked about how I was gonna tell you how institutions, what they're looking for, and what's going to attract that institutional money. One of the things that is a very simple a way you can analyze earnings is to look for what we call a breakout year, and this is done by computers. A lot of these quant funds will do regression and look for certain periods of time where the earnings are in a channel, and when those earnings start to break out of there, or even the estimates start to break out of there, that will initiate interest and some buying, because that means that something has changed in the company. So looking for a breakout year is very simple. You're going to look for stocks that had a period where you were dormant in your earnings, and they just maybe went flat or were really moving up just slightly, and then all of a sudden there's this breakout of that range, and that's something that should get your attention. And again, the key is that none of these things I'm telling you is going to be one particular magic thing that this is going to be the reason you buy. These are all elements that you're going to put together to build a case for a stock that you want to be, whether you should be purchasing or not. And again, even with all these fundamentals, if I see the breakout year, the quarterly earnings accelerating with big earnings, I'm still not going to buy it. If it's not in a stage 2 uptrend, I'm not going to buy it. If it's not coming through a buy point that meets our criteria, which we'll show you later, I'm not going to buy it. So all this is great to have on the table, but once again, we're building a case here. Okay, we're building a case, and we're also getting an understanding of what type of company we have here and what to expect. So this is how we put this together, or how I put this together when I bought Gilead. Gilead, as you can see, I'm buying it right here. And again, we're going to get into technical analysis later of why I'm buying it here and exactly the setup. But I'm buying it here. You can see if you look at the quarterlies, 4% earnings, 15% revenue. Next quarter, 10% earnings. We doubled. 21% revenue. We accelerated. Next quarter, 208%, 97% revenue. Huge acceleration. If you just go back 2 quarters, you went from 4 by 15 to 208 by 97. All right. And again, breakout year right here. Last 1, 2, 3, 4 years, barely any movement in earnings. Very slightly up from $1.85 to $2.04, almost no movement. And all of a sudden, $8, right, is an estimate. And part of that is already coming true right here. You're getting this big earnings. And that's what ignited the stock. Now, again, we don't know how long this is going to continue. And it may not continue very long. You may not have, that's the big $64,000 question. We get everything on the table here, but now it's a matter of, are they going to continue to deliver? And if they continue to deliver these big earnings, you can see the next quarter was 372% and 136% in sales. So remember, we used 100%, and that took $100 to, what was it, 256 times that. Okay, well, this one quarter is almost 4 of those in one quarter, right? The previous quarter is 2 of those, 200% moves, right? So again, you can get there even quicker with these giant earnings.
Mark, I would just add too, this is what creates these powerful trends, because to our point from the last section about the institutions, they're in that slower moving, ship. So they have got to revise their models, and they can't move nearly as quickly, which is why they're buying these dips and pullbacks and creating these strong trends as this fundamental information is ahead of them. It's rapidly getting ahead of them.
Great point. Why? The question is, then why isn't this stock just taking off, and everybody knows this and everybody can see this? Well, first of all, not everybody is knowing all this. That's number one, and puts it together properly. Second of all, not everyone is executing it properly. And again, the institutions, as Mark said, are moving slowly. They're moving slowly. Not everybody's coming in at that one time and that one point. There's lots of information. There's lots of academic and studies and things that are built on very faulty principles in the stock market. Not everybody is good at this. I can assure you, even at the highest, most professional level, most people are very mediocre. This business is no different than if you were a lawyer, a trial attorney, a basketball player, a baseball player. There's only a handful of superstars. All right. So why is the reason? Because you're not going to get all the elephants through a keyhole. That's number one. And all the elephants move slow. So the advantage that you have is that you are smaller and you can move quickly. And with your smaller size, you're not going to move the stock. So it's not going to price everything in. What's going to price things in are the big institutions, the big money. That's what's going to make the stock efficient. And that takes time. Those big moves take time to develop. And many of these institutions get in late. They're buying later within the trend. That's what keeps it going. But we'll get into more of that. All right, so let's talk about something like a turnaround situation. Okay, this is where you would apply acceleration a little bit differently, because what's going to happen now is you're usually going to be having negative earnings or very mediocre earnings. So you're comparing against what we call easy comps. And as I pointed out earlier, when you have those easy comps, now an earnings report that might look good going against normal comps or difficult comps isn't really that good. 30, 40% earnings increase may not be that good. This is where you want to see triple digit, if it's a turnaround situation. If you have a company that came on hard times, maybe you're in a recession, and now there's these really easy comps. They reported a penny a share per share last quarter. Well, if you 5 cents now is 5 cents versus 400% increase. That again, it needs to be very large numbers now. So there's two ways you would look. You would look for the acceleration versus and the comparisons versus these easy comps to be very large numbers. But more importantly, you look at the growth rate. All right. So you can get an acceleration in growth rate. So stock's been growing at negative, maybe in this case, we're talking about a 5-year growth rate of -7% or a 3-year growth rate of 12%. And suddenly you're seeing this acceleration. You're getting the quarterly acceleration, but you look at the growth rate and you say, okay, well, this is actually accelerating versus what it's averaged over the last couple, 3, 4, 5 years. That's another form of a breakout. So again, this concept of breakout, you want to be aware of that. This next slide there should be 5 golden nuggets. Well, actually, there is a golden nugget over here. There should be 5 golden nuggets on it because it really, or these next couple slides, actually, they really tell a big story here and really drive home this point that we've been trying to make here. So let me explain to you about this slide. You can see it says from 2013 Master Trader Program Workshop, which Mark, I believe you were at that one too. You've been at every one, I think, right?
I missed 1 or 2. I think I missed 2012. I missed 1 or 2 in the early days, but
Oh, that's right. Yeah, I remember you did miss one. So in 2013, what I decided to do was at the Master Trader Program, I just picked a stock, like I think it was a week or so before we put out the workbook, and I said, let me just pick a stock that looks like it has good criteria and something that I would, buy here, and I would recommend as a stock to buy. So I put this in the workbook, and I said, what I'm going to do is I'm going to show you a stock, and then a year later, I'm going to go back to it, see how it performed, and but just show what I'm looking at here. So just breaking down this chart, this is using this is actually, you can see we didn't even have MarketSmith back then. We had daily graphs online, which is essentially MarketSmith. MarketSmith is even better, just an improved daily graphs online. So if you take a look at a couple things, look at the growth rate, right? The growth rate right here is 4%. I want you to take note of a few things. You can maybe even write this down on a piece of paper, because we're going to move off this slide in a second. The PE is 21, right? Okay. Your earnings here, your earnings are averaging 29%. You can see you got some acceleration versus the last 3 quarters. You're 11, 19, 18, now 13, 30, 17. You got a little deceleration, but you're averaging about 29%. Pretty good earnings acceleration right there. Positive sales, nothing really big. Let's see here. Let's look at we have a breakout year. You see you're really kind of growing. Not too strong, but you got these breakouts here coming. Okay, and the relative strength is 90. You're in an uptrend. You're in a stage 2 uptrend, and you're coming out of a well-formed base. So you've got a number of things here that look pretty good, right? But here's what I want to show you. This is what's really important. So now, when we see the stock here, it started at a relative strength of 90. This right here is where this chart starts, right here. Okay, right here. There from the previous page. So it did pretty well. It had a pretty good move. I don't know how much it went up here, but it's on $60 to maybe 90 or so. It had a nice move. Let's look here. Now that we're a year or so later, or about a year later, the relative strength is actually lower. Okay, that's the first thing you want to look at. The relative strength is an 85. So high relative strength. Some people think, well, I'm going to buy a 60 relative strength because I want to buy it before it becomes a 90 or high relative strength. Why would I buy it at 99 when I can buy it lower? Well, that doesn't mean relative strength is relative. A stock could be moving sideways or going down, just going down less than the market, less than the rest of the stocks in the market, and you'll have a relative strength that will be high or be moving up. So relative strength, you always want that number to be strong now, currently, and the stock can go up, and it might go up less than its peers, and at some point in the relative strength come down. So that's the first thing to note. But we're on earnings now, right? And fundamentals. The PE ratio, the growth rate was 4%. Now it's 23. You see, drastic acceleration, big acceleration in growth rate. And that was only 1 year. 1 year affected the 5-year growth rate that dramatically. Now, the stock went up, not 100%, but a pretty good move. The PE is unchanged. Just like we talked about in valuation. And this PE could have been 90, could have been like Yahoo, which was 938 times earnings. And then we look later on, and the PE was 1700. It expanded. It could be where you go and the stock goes up 200% and the PE is actually lower. It's a better valuation at a higher price. Why? Because the earnings came in. See, the earnings came in, and you can see here the earnings. You have, with the exception of 1 quarter, you had strong earnings growth. Now, here's the real key to this whole thing. If we go back here, and this little red circle is just showing these estimates right here. The street was estimating that in 2013 you'd have $2.97, and in 2014 they would report 337. But what actually happened was 307, okay, was better. And in 2014, it was 376, much, much better. What this shows is that, again, the limited visibility. Now, this is with pretty small numbers and only, 1 year out, an estimate 1 year out. So if you were to go out even further and say you went out 2 years, 3 years, the accuracy is going to go off a cliff, and they're going to be nowhere near what actually happens, up or down.
Mark, I want to make the point too that this is a huge company at the time. I mean, Home Depot is a big stock, and this is still what's ultimately driving that big move. So my point is, this is what is going to drive institutions to names. But if you take this same idea to mid and small cap names, this is where the prices can be and moves can be much more powerful. I think, yeah, I'm reading that right. $120 billion market cap. I mean, this company was no secret, and yet still had a powerful move once those numbers started showing up.
But what Mark is saying is that there's a whole bunch of analysts that follow this, teams of analysts. Fidelity probably has 20 analysts following this thing before they buy it, and they can't get it right. They can't get it right. That limited visibility, that conservative nature that we talked about, it applies to these big companies. But when you get to a small company, as Mark just said, this is magnified. And now you get to a small company that doesn't have many analysts following it, isn't followed very much and priced properly, and you've got large numbers. Now these big earnings are coming in, so now it's completely mispriced, and that's how you get these huge moves. All right,
golden nugget right there.
Absolutely golden nugget. And now we're going to look at it in the opposite direction. Okay, we're going to look at, because a year later, when I came back to the Master Trader program, right here, I said last year, I included these slides, and I said last year I picked a stock, and this is what happened. And this year I'm going to pick a stock to avoid. And then a year from now, we're going to look at that, and we're going to see. And I picked Lumber Liquidators, which was a previous market leader. If you remember, we talked about this. This was a market leader in this uptrend here. I actually bought this stock. Unfortunately, I got shaken out of it. I didn't participate in anywhere near the amount that I should have. But again, I was in this, buying this as it was emerging, as a leader here. And then it went to stage 3 and stage 4. And I noticed this, and I said, okay, this is the stock I'm going to pick as an avoid, or even a short. So again, we're going to apply the same thing. We're going to look at the same analysis as we just did, but we're going to do it in reverse now. Okay. So let's look at the relative strength. It's a 3, right? Take note of that. The PE is a 22. The estimates are for -4? I'm sorry about that. -4%, and then 21% gain in 2015. You can see earnings here in the current quarter were down 14%, down 18%. Now let's fast forward a year later. And again, when we were doing this, we didn't have the benefit of the hindsight until a year later. We took a look at it. So estimates were for 2014 to be $2.67, and in 2015, $3.22. Let's look at what actually happened. Well, in 2014, they were off by a bit, 231, right? But now, fast forward one more year, and here's where the visibility goes down the tubes. Instead of $3.22, they lost $1.20, just a little off, $4. Yeah. So again, now here's another key. The P ratio here is 22. The stock gets clobbered and goes down like 90%. And now the PE is 86. How is it trading? How is it so much more expensive when it came down so much? Because the earnings. See, the stock is going down, but the earnings are going down more, faster. And if you have negative earnings, you don't even have a PE ratio, right? Look, and you can see here, look at how the earnings, they just evaporated. And all the bad news comes in later. And look at the sales. You got the negative sales didn't come down for 4 quarters later, then the negative sales come in. Again, that limited visibility, you see, and this is where the opportunity is. This is where this slow moving Wall Street and being able to adjust to these numbers and just not having the coverage. These are the smaller companies just don't have the coverage. And even we look at Home Depot, you look at Coca-Cola, Microsoft, thousands of funds owning them and following them, they're swimming against their own tide, because even if they get it right, there's so much supply, there's so much ownership that it's already over-owned. There's not much firepower anymore. Everybody owns the stock. So there's a lot of reasons behind this, but this is the concept that you have to understand. So I'm not going to go over this. There's a few things on here that you just are for your own edification and you can take a look at, but this is some tips on how you can measure an earnings report to go beyond the number reported, to know if it truly is a good report. The main thing is that you need to gauge 3 things. 1, the initial response to the report, your subsequent strength, because sometimes you sell off a bit on earnings, and then a day later, stock starts taking off and it holds up relatively well, and also the resilience of whether it can snap back very quickly from a pullback. That price action. This is where the differential disclosure comes in. Compare the news, the earnings, the sales, the report to how the stock price is acting. Not only on a longer term basis, see if it's an uptrend versus a downtrend, but also even on an earnings report, what says to be a surprise. They come out with 10 cents above estimates, but the stock's down 20%. That's not a good earnings report. Okay, that's not a good earnings report. All right, let's move on to profit margins now. This is the third piece. Now everything that we just talked about, it sounds like a lot, maybe, and after profit margins, there's going to be even more here, and it might sound like a lot to say, wow, this is a lot to understand, a lot to put into use. No, it's really not. It's really not, because you just need to understand this concept. The tactics that I'm going to show you and I'm giving you now are quite basic, but they're powerful. Okay, with the simplicity comes power, and then the real key is stacking them, using all these things together. And that's the true essence of specific entry point analysis, is taking all of this and building all the probabilities to where it all comes to a fine moment where that is the moment to purchase at a high probability, low risk entry. So we're going to talk about profit margins now. And again, I'm going to give you some perspective here. Tell you a little story here about a made-up company. And this is a little company that we're going to make up. We're going to call it a grocery store, because grocery stores have very low margins, and I want to make a point here with margins. Let's just say it's a little mom and pop shop. This could be 10 million, it could be 100 million, doesn't really matter. I'm just going to use revenue of $1 million, profit margins of 1%. The market cap of the company is 100,000 shares. So if you take $1 million in revenue times 1% profit margins, that equals $10,000. You divide that by 100,000 shares, you get 10 cents per share. That would be your earnings. If this was a public company or whatever, you would have 10 cents per share based on this information. So let's say that we're going to give 2 scenarios. The first scenario is that revenue is unchanged. Okay, the revenue is unchanged. I'm sorry, the profit margins are unchanged, and the revenue is up 25%. So you've grown your revenue. You've gone from $1 million in revenue to $1,250,000, but your profit margin remains at that 1%, right? So your earnings are obviously going to be up. They're going to be up 25% because you're at the same profit margin and your revenue is grown. So that pushes your earnings now. That 1.25 million times 1%, it gives you 12,500 divided by 100,000. You've now got 12.5 cents per share, right? Your earnings are up. Okay, great. Not a bad report. But scenario B is you're going to have the same revenue. Okay, revenue is still up 25%. Only in this scenario, you're going to increase your margins by just 1%. Okay, now with a company like a grocery store that has very low margins, something like a Walmart or a grocery store is operating on, depending what period, 1, 2, 3% margins, very low margins. They operate on volume, right? So a 1% increase in margin that sounds so small, it actually doubled the margins here. So now let's run that same scenario. Revenue's up 25%, right? That's that 1.25 million, right? But profit margins now go up 2%, just 1% more. Let's do the math. You take the 12.5 times 2% is 25,000 divided by 100,000 shares, 25 cents per share. Now earnings are up 150%. You got triple digit earnings, all from 1% margin increase. Now, how about if we grew revenue too? I'm not going to do the math. You can do the math. Grow revenue by 50%, 100%, and apply that margin. This is, again, how you get stocks. How can a stock go from $10 to $100 in a year? This is how. And when you put all this together and you have an understanding of it, you can start to understand what's going on and how to get there fundamentally. Now, let's look at a real life scenario, okay? Because this is a stock that I was buying and David Ryan was buying around the same time. There's a perfect example to make this point. You look at Ollie's, and this chart, actually, I don't think we have it credited, but it's from Value Line. It's one of the Value Line tear sheets. So they reported 50% earnings in this year in 2016. Their revenue was up 16.8%, and their margins were 6.7%. So versus the previous year, which was 4.7%, that was a 42.6% increase in margins. So the real story behind this, even though earnings were up, that would certainly fuel. Even though revenue were up, that would certainly fuel earnings. A 16.8% increase in revenue would produce an increase in earnings if the profit margins were the same. But the real power behind this came from the combination of the two. When you put the margins in there, that's what boosted it, and you got those 50% earnings. Let's take the margins and just keep them unchanged. Okay, which would still be, they're growing the company, it would be fine. So without the profit margins, now you've got, that was 4.7% versus 4.7%. Earnings would only be up 7.81% now. See, so the real power under the hood were the profit margins turbocharging. Now, let's say that revenue was up 100%, and even margins are up 10 or 15%, 20%. Again, you'd have these explosive earnings. You would have huge, enormous earnings. And this is what can happen. I'll show you some more examples. This is what happened with Apollo. We're going to go back to Apollo. Remember, I told you, I'm going to keep showing you a lot of these examples that I showed you previously. I'll show you in the stage analysis. So you'll see the 1, 2, 3, 4 stage, and you'll see it's in a stage 2 uptrend. Then I'll show you in the earnings, or maybe in the comparison to the market, to show you how it was a market leader versus the market. Then I'll show you in the earnings and the sales. And now we're in profit margins. So you're going to see how all this is built into these winners that I'm showing you that I participated in, and some of the better names, and how this all chronologically, we put this together. And then when it's all done, you'll have that full puzzle with all the pieces in there and understand how they all fit in to this one big picture. And it won't seem so overwhelming. So again, look at the net profit margins. They go from 11.7 to 14 to 16 to 18.4. You've almost doubled your profit margins. Huge, enormous. If you apply that to even flat revenue, which they had revenue up, that would really grow. That would really grow the earnings, and that's why the stock was up 850% versus at the Nasdaq down 60%. So even as Mark mentioned before, even in a tough market, these stocks are in their own earnings cycle. Let's look at Panera Bread. This is another name that I was in early on, 2000. You had 4.7% margins like Ali had in 2000 to 2020, 2001, they went up to 6.5. Then they went from 6.5 to 7.8, from 7.8 to 8.6 on big revenue. This produced an 1,100% return on the stock advance versus the Nasdaq down 80% during that period. And again, we're not going back to like say, hey, I was in this stock and look at me, I picked this stock. We're explaining for you to understand the concept of what drives these prices. And now if you can participate in these type of fundamentals in companies that are in a bull market, then you have not only you have an incredible opportunity in these individual companies, but in the overall market, there will be lots of opportunities. And that's where you can really make a lot of money in a lot of different areas. Monster Beverage. Remember I said, if you go back, you look at Coca-Cola in the early 1900s, no difference. Profit margins improving, sales ballooning, led to big earnings, big stock price. 2003, sales up 20%. Margins went from 3.3 to 5.4. You go to 2004, sales are up 63% now, right? Acceleration, big acceleration, but earnings turbocharging it. Net profit margins double. Profit margins double. Gross margins double too. 5.4 versus 11.3. And now you go to 2005. No wonder the earnings are up 197%. Sales are up 93%, and margins went from 18%, from 11.3% to 18%. Again, go back to 2 years earlier, from 2003 to 2005, you started at 3.3% margins, the margins of like a grocery store. And then a couple of years later, you're at 18%. You're at margins of a high-tech software company.
This is Mark. This is a perfect example of the point we were both making. Home Depot, yes, strong move, but same principle on a smaller cap stock. This stock went up 10x in 18 months. This is because, to your point, there weren't as many analysts covering it. The market is discounting a massive amount of growth very quickly. And this was a fad for those of you who remember when the monsters first started coming out. Everybody was buying them. I used to work with guys who would drink 3 or 4 of them a day. It was that beginning of that energy drink type of thing. You can't price in the earnings growth fast enough, which is why this stock is just absolutely on fire.
Absolutely. And one of they call it the great turnaround is Apple. Apple is a profit margin story all the way. And that was because they came out with this product that they refined. They refined the development of it and the production of it. And they had pricing power because they had this phenomenal product that nobody else had that was life-changing to the world, and they had pricing power. And if you go back and you take a look at when Apple started faltering, you'll see that the profit more the on the street, Wall Street was talking about how they're losing pricing power. You came in and you had Samsung and other alternatives, and there's the competition, and then of course Steve Jobs passed away, and there hasn't been much innovation, and now they're losing some of their pricing power. So you have to have a choice. You're going to either lose volume or you're going to lower your price, and your margins are going to contract. Either way, it's not good. But the great turnaround was driven by this wonderful product that was selling like hotcakes and an expansion in profit margins, pricing power. Again, if you go back to the very beginning, remember what I said, there was 2 scenarios. The best were you had pricing power, you had growth, you had strong scalable businesses. The worst case scenario was limited pricing power, big regulation, cyclical industries. Just the opposite. Apple had all those things where you had an unregulated area, you had a new product, scalable, a huge market, explosive market potential worldwide, and profit margins or a result of pricing power. So, but look at these numbers. You started in 2003 with 1% profit margins, and they expanded consistently all throughout the decade, pretty much up to where you were at 20, almost 24 times the original margin. You went from 1% profit margins to almost 24% profit margins. I mean, that is, colossal. And that's why you had a colossal stock. All right. So now the real power in this is to put them together. And I told you a couple things. One, how you would turbocharge, you can turbocharge those earnings and the revenue with the profit margins. And you can look for this, of course, you want to find stocks that have these characteristics. We talked about in the very beginning on how there's computer models, there's quant funds that are looking for this stuff. And basically a very simple approach is what I call using what we call the code 3 matrix. A code 33 is how we term it, when you have all three. You have earnings, sales, and margins all accelerating over 3 quarters. That's sort of your best scenario. That's like a really strong scenario that you want to focus on. If you have 2 quarters, okay, then you would go from a 33 to a 21. And if you go down to 1 quarter, you would have an 11, and so forth. You can see the matrix here and how it's laid out. So now, if you had 1 quarter of acceleration and you saw accelerating earnings, that might be something that you start watching. You see if there's another quarter, if the stock's acting well. It doesn't have to be 3 quarters. You can have just 1 or 2 quarters, and you'll live with it, and maybe you'll buy that stock if it meets all the criteria properly, technically. But this is what you're looking for. This is what you're looking for. And the longer that this goes on, where you get this expansion, and the more you can get it across the board, where you're expanding the revenue and the profit margins, it's going to lead to expanding earnings. And again, you can look for differential disclosure. You see a code 33, it's got earnings, sales, margins, everything's expanding. Fundamentals look great, big giant numbers in the current quarter, right? But the stock is in a stage 4 uptrend. What does that say? That says that you can throw all these numbers out the window, because guess what? Differential disclosure. The price is discounting. It's discounting something is up there. So they got to agree. Okay. If there's the things that you have to come away with this chapter are not secret formulas where, oh, I'm going to look for a breakout year and buy all the stocks that have breakout years. No, this is all evidence to build a case. And then what's very important is to gauge against the price action. And does it make sense? Is the picture coming together where you have all the evidence? So when you have all the evidence, that's a stock that you're going to consider. And then we still there's a lot more that we're going to be a technical analysis and so forth. But this is the basics around, or I shouldn't even say this is the basics. This is everything. There's nothing more. I don't do anything more when it comes to fundamentals. This is it. I don't look at anything else that is really affecting my decision. I'm aware of, I can see the, return on equity and various metrics that are laid out on a Market Smith chart. But this is what I analyze and affects my decision. I just become really, really good at analyzing these few very important metrics, which, like I said before, there's a million things not to do. There's only a few that you have to get down and master to be really great at this. And that's what you want to focus on. Let me see here, just to ending this section. So again, I'm not going to go through this. These are just some things to watch: earnings, sales, and margins, positive and negative, just recapping some of the things we talked about. Mark, do you have any final points here? We're going to take a break here in just a minute.
Yeah, I was just going to say, this really is kind of, like you said, the bedrock in terms of the fundamental work I do. And the nice thing about Market Smith is it's all right there in one window for you. And they didn't used to have the margins. Now they even have the margins. I think thanks to you, or you pestered them enough where they added it a few years ago, where you didn't have to go somewhere else to get it. And you can, you looking for those breakout years, as things set up, it with what we're going to get to next, it just, you're stacking probabilities on top of each other. And you don't have to worry about getting on earnings calls and looking at balance sheets. I don't do any of those things. I just look exactly precisely what we talked about, say, over the last 45 minutes.
Yeah, and a couple of things. One is MarketSmith. I'm not sure if it was because of David, Ryan, and I, but we did lobby for profit margins to be put on the chart for a number of years. We made that suggestion, and then they showed up. So again, I'm not sure if we had anything to do with that, but what matters is that they've got all the information right there. That's why I've been using the product for, and that's why they're our sponsor, because I don't not because we're paid to say MarketSmith's good, because I've been using the product for 30 years and I love the product. It's the category killer. So again, it's all laid out there. Another thing is that all this information, all right, that we're presenting here, again, is not necessarily where, again, there's any one secret thing, where you're going to, like I said, look for the breakout year, acceleration. These are all elements to all bring together and to create. There's a lot of subjectiveness involved in this, and it's a skill. There's a skill in putting this all together, and it may seem like there's a lot here, and there is, but it's a lot simpler than you think. It's a lot more straightforward than you think. And the more you remove all the moving parts and you bring it down to the elements that I'm going to show you, and you master them, you spend a couple of years doing this. And is it worth 3, 4, 5 years to get to a point where you can do really, really well in the stock market and have this unlimited opportunity, an opportunity that literally completely changed my life from being as poor can be, to a multi-millionaire in a very short period of time, and a decamillionaire shortly after that. It completely changed my life, and many people around the world that have been our members, our customers, our clients, and so forth, and those who have read my books. So it's going to take some time, but it's well worth the investment. It's well worth the investment. So if some people get this far and they're already overwhelmed, and I assure you, by the time we get to another day or two, your head is going to feel like it's swollen. It's going to just explode. But we'll get you there. All right, hang in there with us. We'll get you there. And for those of you that are advanced, and maybe this has been simple to you, I assure you it's going to get more complex, and there's going to be a lot of enlightening moments. So we're going to take a break now, and then we're going to come back and finish up today with getting into some of the technicals, a little bit maybe more fun stuff for some of you, and we'll get into that when we come back here. We're going to take a break just for a little bit. Okay, we'll be back.
All right, guys, I know Mark was just talking about the amount of information, and it's getting more, but I can imagine a lot of you are getting a bit overwhelmed right now. I'm getting some comments here, appreciating all the information and comments. So let's just take a 5-minute break here. Then we're going to have the final session of the day, being picture worth $1 million. So be back in 5 minutes. Try to do perhaps 10 push-ups. I like to get the blood pumping, get your brain flowing. See you in 5.